Introduction to Investing. Welcome to the world of investing, where your money has the potential to work for you and grow over time. Investing is a strategic process of allocating your funds into various assets with the aim of generating returns in the future. These assets encompass a wide range of opportunities, including stocks, bonds, mutual funds, real estate, and more. Think of investing as planting seeds today to reap a bountiful harvest tomorrow. As a beginner, it's natural to feel overwhelmed by the plethora of investment options available. However, understanding these options is key to making informed decisions that can propel you towards your financial goals. Each investment avenue carries its own set of risks and rewards. For instance, stocks may offer high potential returns but come with volatility, while bonds provide stability but lower return. Real estate investments can offer steady income through rental properties or appreciation in property. Before diving into the investing pool, take the time to assess your financial goals and risk tolerance. Are you saving for retirement, a dream vacation, or your child's education? Knowing your objectives will guide your investment strategy and help you stay focused amidst market fluctuations. Sarah is a young professional who wants to start investing to build wealth for her future. After careful consideration, she decides to allocate a portion of her savings into a diversified portfolio consisting of stocks, bonds, and real estate investment trusts. By spreading her investments across different asset classes, Sarah aims to minimize risk while maximizing potential return. In summary, investing is not just about putting your money into assets. It's about making informed choices that align with your financial aspirations. With patience, diligence, and a well-thought-out strategy, you can set yourself on the path toward financial freedom and abundance. Setting financial goals. Before embarking on your investing journey, it's crucial to establish clear financial objectives. Take a moment to envision what you hope to achieve with your investments. Are you aiming to secure a comfortable retirement, purchase a dream home, or ensure your children's education? For instance, suppose you dream of retiring comfortably at 65, traveling the world, and pursuing your passions. In that case, your financial goal might involve building a robust retirement fund that can sustain your desired lifestyle without financial stress. Similarly, if you aspire to buy a home within the next 5 years, your investment strategy may prioritize capital preservation and liquidity to ensure you have enough funds for a down payment when the time. Moreover, if funding your children's education is a priority, you might focus on growth-oriented investments to generate significant returns over the long term, aligning with the timeline of their college enrollment. By delineating your short-term and long-term financial goals, you lay the foundation for a purposeful investment strategy. This clarity allows you to tailor your approach, allocating resources effectively to achieve each milestone on your financial journey. Remember, setting financial goals is not just about dreams. It's about turning them into tangible, achievable targets through strategic planning and disciplined investing. Understanding risk and return. In the world of investing, the relationship between risk and return is a cornerstone principle that every investor must grasp. Simply put, it's about weighing the potential rewards against the potential risks associated with an investment. Let's break it down in a more organized manner. It's often observed that investments offering the potential for higher returns typically come with higher levels of risk. For instance, investing in volatile stocks or emerging markets might promise lucrative returns, but they also carry a higher likelihood of experiencing significant losses. Lower returns, lower risks. On the flip side, investments with lower potential returns tend to come with lower levels of risk. For example, government bonds or high-quality corporate bonds may offer relatively modest returns, but they are generally considered safer investments compared to speculative stocks. Every investor has a different comfort level when it comes to risk. Some may be willing to take on higher levels of risk in pursuit of greater returns, while others may prefer to prioritize capital preservation and opt for lower-risk investments. Understanding your risk tolerance is crucial as it helps you align your investment decisions with your financial goals and personal preferences. Achieving a balance between risk and return is paramount in constructing a well-rounded investment portfolio. It involves diversifying your investments across different asset classes, such as stocks, bonds, real estate, and by spreading your investments, you can mitigate the impact of any single investment's underperformance and enhance the overall stability of your portfolio. Knowing informed decisions. Knowledge about the risks involved in investments empowers you to make informed decisions. Conducting thorough research, staying updated on market trends, and seeking advice from financial professionals can help you navigate the complexities of investing with confidence. Let's illustrate this with an example. Option offers the potential for high returns, but carries a significant risk of volatility, while option B provides more stable returns with lower associated risks. Your risk tolerance and investment horizon will play a crucial role in determining which option is more suitable for you. By understanding the relationship between risk and return, you can make a well-informed decision that aligns with your financial objectives and preferences. Remember, investing is not just about chasing high returns. It's also about managing risks effectively to safeguard your financial future. Building a diversified portfolio. Diversification is akin to spreading your eggs across multiple baskets. It's a strategic approach that involves investing your money across various asset classes to reduce the impact of any single investment's performance on your overall portfolio. For example, imagine you have $10,000 to invest. Instead of putting all of it into one stock, you could allocate a portion to stocks, bonds, real estate investment trusts, and perhaps even a small percentage into alternative investments like commodities or cryptocurrencies. This way, if one sector experiences a downturn, the other areas of your portfolio can potentially offset those losses, helping to mitigate overall risk. But diversification isn't just about investing in different types of assets. It also involves spreading your investments across different geographic regions, industries, and investment strategies. For instance, you might diversify your stock holdings by investing in companies from various sectors such as technology, healthcare, finance, and consumer goods. Similarly, you could diversify geographically by investing in companies based in different countries or regions, reducing your exposure to any one economy or geopolitical event. By diversifying your portfolio in this manner, you're not only reducing risk but also increasing your chances of achieving more consistent returns over the long term. It's a fundamental principle of investing that can help safeguard your wealth against market volatility and unforeseen events. So remember, don't put all your eggs in one basket. Diversify wisely for a more resilient investment portfolio. Getting started with investing. Congratulations on taking the first steps towards building your financial future through investing. Now that you've gained a foundational understanding of investing principles, it's time to put your knowledge into action. The first step is to open a brokerage account. This account serves as your gateway to the financial markets, allowing you to buy and sell investments such as stocks, bonds, and mutual funds. Many reputable brokerage firms offer user-friendly platforms for beginners. Imagine a brokerage account as a digital wallet where you store and manage your investments. Just like you need a bank account to manage your money, a brokerage account is essential for managing your investments. With your brokerage account set up, it's time to research investment options. Take the time to explore different asset classes, industries, and investment vehicles to find opportunities that align with your financial goals and risk tolerance. Suppose you're interested in investing in technology companies. Research various tech stocks and assess their financial performance, growth prospects, and market trends to make informed investment decisions. Developing a clear investment plan is crucial for success. Define your financial goals, whether it's saving for retirement, buying a home, or funding your children's education. Then, outline a strategy for achieving those goals, considering factors such as investment timeline, risk tolerance, and diversification. If your goal is to retire comfortably in 30 years, your investment plan might involve allocating a portion of your portfolio to growth-oriented assets like stocks for long-term wealth accumulation, while also including more conservative investments like bonds for stability. Investing requires discipline and ongoing education. Stay disciplined by sticking to your investment plan and avoiding impulsive decisions driven by market fluctuations or emotions. Keep yourself informed about market trends, economic indicators, and investment strategies through resources such as books, online courses. During periods of market volatility, it's natural to feel anxious about your investments. However, remember that staying disciplined and sticking to your long-term investment strategy can help you ride out market fluctuations and achieve your financial goals. By following these steps and staying committed to your investment journey, you can build a solid foundation for financial success and achieve your long-term objectives. Remember, investing is a journey, and each step you take brings you closer to your financial aspirations. Embarking on your investing journey. Congratulations! You've now been equipped with the fundamental knowledge needed to begin your journey into the world of investing. As you step into this realm, it's important to remember a few key points. Understand that investing is not a one-time event, but rather a continuous journey. Just like any journey, it requires patience, perseverance, and a commitment to learning and growing along the way. Think of investing as planting seeds in a garden. You need to nurture your investments over time, watering them regularly with additional contributions and adjusting your strategy as needed until they blossom into a bountiful harvest of wealth. Rome wasn't built in a day, and neither is a robust investment portfolio. Avoid the temptation to chase quick gains or panic during market downturns. Instead, stay focused on your long-term financial goals and stick to your investment plan. Imagine you're on a hiking trail with steep inclines and rocky terrain. It may be challenging at times, but by staying focused on the breathtaking views waiting for you at the summit, you'll find the motivation to keep moving forward, one step at a time. Watch your wealth grow over time. Investing is a powerful tool for building wealth, but it requires time for your investments to compound and grow. Trust in the power of compound interest and the long-term potential of the markets to steadily increase your wealth over time. Consider the story of the tortoise and the hare. While the hare may sprint ahead in the short term, it's the steady and consistent progress of the tortoise that ultimately wins the race. Similarly, by staying committed to your investment strategy and allowing your wealth to grow steadily over time, you'll achieve financial success in the end. With dedication and diligence, you have the ability to achieve your financial goals and build a secure financial future for yourself and your loved ones. So embrace the journey, stay the course, and watch as your wealth blossoms and flourishes over. Happy investing!